Hello, and thank you for tuning in to the Fi Mastery Podcast, where our focus is on providing tools, resources, and insights that empower driven individuals to secure their own path to financial independence. My name is Peter Donisanu, and today we're going to talk about the cost of having too many financial accounts. Now, let's face it, many of us feel that having a number of financial accounts with various financial institutions gives us a certain level of sophistication when it comes to managing our money. But the truth is that increased complexity has both mental and financial costs that can set you back from your near and long-term financial goals. That's why in today's episode, we'll explore what those costs may be and spend time discussing the benefits of financial simplicity, including some approaches you can take to get your financial house in order. So with that, let's dive into today's podcast. Did you know that having too many financial accounts can actually be more counterproductive than it's useful? Certainly, while some individuals view having multiple financial accounts as making them better stewards of their finances, the truth is that being overbanked can lead to serious financial problems. And that's exactly what happened to Brian. Now, Brian is an ambitious entrepreneur with a passion for personal finance. And Brian believed that the more accounts that he had, the better that he could manage his finances and grow his wealth. Even so, little did Brian know that his obsession with opening and managing various financial accounts would take a toll on his mental health and cost him dearly. And that's not because Brian didn't know how to manage his money. In fact, Brian had always been a high achiever. He graduated at the top of his class from business school and quickly climbed the corporate ladder, earning a six-figure salary that enabled him to make the leap and start his own business. Now, as his wealth grew, so did his appetite for diversification. So much so that Brian believed that opening multiple bank accounts, multiple credit cards, and investment accounts would provide him with better financial security and opportunities for growth. And so, over the years, Brian accumulated several dozen bank accounts, credit cards, and investment accounts. Even so, Brian meticulously tracked the balances and interest rates and fees for each account, ensuring that he maximized its returns. And in fact, he spent countless hours poring over spreadsheets and statements, monitoring his cash flows, and making complex transactions between accounts. Now, at first, Brian's strategy seemed to work. His wealth grew and he felt a sense of accomplishment from his financial prowess. But as Brian brought on new clients and his business grew, so did the complexity of his financial situation. And as his finances became more complex, Brian's stress level started to rise. Indeed, whenever a financial statement arrived in the mail or an email notification popped up on his phone, Brian felt a wave of anxiety wash over him. The truth is that the sheer volume of information related to his finances was so overwhelming that he struggled to keep track of all of the financial details. Now, a turning point came when Brian actually missed a credit card payment deadline. Up to this point, he'd always prided himself on his financial responsibility, but the oversight led to a hefty late payment and a hit to his credit score. And it was this incident that shook Brian to his core, forcing him to question whether his financial strategy was really working. Even so, despite the warning signs, Brian stubbornly refused to simplify his finances. In his mind, he believed that his system, while complex, was still the best way to manage his money, and this decision came at a steep financial cost. That's because the stress from managing so many accounts at one time led to more oversights and errors, resulting in additional fees and penalties. And as this happened, his stress level rocketed, which affected his work performance and his personal relationships. So what happened? Well, Brian's once pristine credit score plummeted, making it difficult for him to secure cheap funding to keep his business afloat. What's more, his investment account suffered because he was unable to give each account the attention that it required. And eventually, Brian's professional and personal life began to suffer as a result of his financial struggles. And only when Brian hit rock bottom did he finally recognize that something needed to change. It was at that point that he realized that his finances had become unmanageable, leading him to admit that he needed to simplify his financial life. Now, as Brian began working to simplify his financial life, he noticed a significant decrease in his stress level. In fact, he no longer spent countless hours poring over financial statements or worrying about missed important deadlines. And as a result, his professional performance improved and he gradually repaired his relationships with his friends and his family. Now, in the end, Brian learned a valuable lesson, and that's that sometimes less is more. His pursuit of financial complexity had limited Brian's ability to remain financially flexible, ultimately costing him far more than it earned. And by embracing simplicity, Brian was able to finally regain control of his finances and, more importantly, over his life. Now, can you relate to Brian? The truth is that many individuals today are overbanked or have too many financial accounts spread across various financial institutions, and it's costing them their ability to manage everyday stresses and to remain resilient to one-time shock events. In turn, these complex processes for managing their finances quickly spiral out of control, leading to unnecessary financial costs and setback. Indeed, there are many costs associated with being overbanked, and it all starts with cognitive overload. So what is cognitive overload? Well, cognitive overload is when you become so stressed that you don't know what to do next. And this typically happens when your brain can't process and handle overwhelming amounts of information it's receiving because there's so many things coming at you at once. Now, Eldar Shafir has a lot to say about cognitive overload. That's because Shafir is a cognitive psychologist whose work focuses on how cognitive limitations such as cognitive overload can affect decision-making and behavior in various life domains. And Shafir, along with other behavioral economists, studied how your mental resources can become scarce when you're faced with income challenges, time pressures, or other demanding situations. Now, according to his work, when you experience cognitive overload due to resource scarcity, it can lead to a phenomenon called tunneling. And tunneling occurs when you're focusing your attention on the immediate problem at hand, which forces you to neglect other important aspects of your life. And as a result, you may struggle to make sound decisions or engage in effective problem solving when it comes to your money. Indeed, in a study conducted by Shafir and his colleagues, participants were given a challenging financial decision to make, with some participants facing a high-pressure situation that simulated financial scarcity while others faced low-pressure simulations. Now, those in the high-pressure conditions experienced that cognitive overload, leading them to make suboptimal financial decisions compared to those in the low-pressure conditions. Now, what this study illustrates is that when you're overbanked and your financial management process becomes so complex that it takes up too much of your attention, it leaves little room for other essential professional and personal life obligations, especially when sudden life changes take place in your home. When this happens, you may feel mentally exhausted, find it difficult to focus on tasks, and struggle to make critical decisions. In turn, tunneling can affect your productivity, your creativity, and overall well-being because your mental resources are committed to solving one complex financial problem. It can also cause additional stress and anxiety, leading to burnout and decreased life satisfaction. And moreover, when your brain is preoccupied with one domain of your life, like staying on top of managing your various financial accounts, it may be less able to switch gears and focus on other tasks in your life. As we mentioned before, the situation can lead to reduced creativity and problem-solving ability, as well as increased risk of errors or oversights in other parts of your life, like staying on top of your workload or managing essential relationships. Now, maybe you're in a situation where you have various deposit, credit, and investment accounts spread across various financial institutions and are doing just fine managing them at the time being. Now, the trouble is that while you may have a well-oiled process right now to manage all of your complexity, all it takes is one overwhelming life event to put a kink in your complex financial process, ultimately leading to cognitive overload and potentially costly financial mistakes down the road. And what are these costs? Well, having multiple deposit accounts like checking and savings accounts can lead to increased fees and expenses if you become distracted by other pressing personal or professional matters in your life. That's because when you're managing several accounts spread across different institutions, it's easy to overlook minimum balance requirements, which may result in monthly maintenance fees. And if you're using 3, 4, or 5 deposit accounts to pay various expenses, chances are that you may encounter the occasional overdraft charge if you forget to make a transfer from one account to the other. And at the very least, it can make it hard for you to determine where your money's going each month. Now, at this point, you may be tempted to believe that when times get tough, you can just put your expenses on your credit cards to avoid these potential bank charges. But when it comes to your credit cards, managing multiple cards can make it more challenging to track your spending and pay off your balances on time, leading to interest charges and potential late payments when the inevitable road bump or pothole comes along in your journey to financial independence. What's more, having too many accounts can not only affect your propensity to spend wisely, it can also negatively impact your credit score. For example, each time you apply for a new card, there's a hard inquiry on your credit report, which can lower your overall score and make it more expensive to borrow money in the future. And finally, when it comes to your investment accounts, there is such a thing as having too much of a good thing. Indeed, when it comes to your investment accounts, managing multiple accounts can lead to inefficiencies, including suboptimal asset allocations and paying too much in performance fees. That's because when you have too many investment accounts, tracking each account's performance and combined allocation can be time-consuming, making it harder to maintain a well-diversified portfolio. What's more, with so many accounts to manage, you'll likely be less inclined to evaluate the fees that you're paying from various investment products, leading to overall lower performance in the long term. So when it comes down to it, being overbanked or having too many financial accounts can be mentally and emotionally taxing and lead to unnecessary fees and expenses that can delay or even derail your journey to financial independence. That's why it may not always be beneficial to have many accounts spread across various institutions when it comes to your money. So what can you do if you find yourself in Brian's position where you're overbanked and it's beginning to tax your time and cost you money? Well, the short answer here is to simplify. And why simplify? Well, other than the obvious reason that it can reduce the complexities of your life, simplifying your financial account management can have many near and long-term benefits. For example, in the book Your Money or Your Life, authors Vicki Robin and Joe Dominguez emphasize the importance of simplicity and intentionality when it comes to managing your finances. In fact, the authors drive home the point that being overbanked can often lead to confusion and unnecessary complexity in your financial life. To be sure, Robin and Dominguez emphasize the importance of understanding the true value of money in terms of life energy. And you'll recall that life energy is that process of transferring the amount of time that you spend on a given task for an exchange of money. So from this perspective, by simplifying your finances, you're not only more likely to gain a clear perspective on your spending habits, but also on the amount of time and energy you invest in acquiring material possessions. This awareness can lead to more intentional and meaningful use of your financial resources, ultimately improving your overall quality of life. Indeed, embracing simplicity can allow you to cultivate a more fulfilling and purpose-driven life. That's because by reducing physical and financial clutter, you can focus on the activities and the relationships and the experiences that truly bring joy and satisfaction to your life. Sure, managing a complex financial framework can at times make you feel empowered and like you're a good steward of your money. At the same time, however, simplifying your life can help you identify and prioritize your values and help you align your spending habits with your life goals, ultimately leading to a more content and purposeful existence. Now, another take on the concept of simplicity comes from the world of home organization. Now, Marie Kondo, known for her KonMari method of tidying and organizing, offers valuable insights on how you may want to consider decluttering the number of financial accounts you have, which can help simplify your financial life. That's because Kondo believes that decluttering and simplifying your surroundings can profoundly impact your mental and emotional well-being. And what Marie says is that by only keeping items that spark joy in your life, you cultivate an environment filled with positivity and happiness. And when you do, you'll likely experience less stress and anxiety, and as a result, your mind likely will be clearer and more focused. So how does this process work? Well, the KonMari method encourages you to be more mindful of your possessions and their value. By focusing on simplicity, you develop a deeper understanding of what truly matters to you. And as you carefully consider each of your financial accounts and determine whether or not its management sparks joy for you, you can become more conscious of your consumption habits and, more importantly, learn how to appreciate how you spend your life energy. So now that we've discussed the emotional and financial costs of being overbanked and how simplifying your life and finances can help you cut stress and achieve peace of mind, how do you actually go about the process of reducing the number of accounts that you manage? Well, one approach to simplifying your financial management is to align your financial accounts with your money's purpose. And so what exactly does this mean? Well, you'll likely recall in our recent articles that we've discussed how essential it is to identify your values, crystallize your life purpose, and align your money with these priorities. So then from this perspective, if your values and life purpose guide how you use your money, then how you manage your financial accounts is an extension of making your life goals a reality. Indeed, when you take the time to examine your financial accounts, you may discover that some of them no longer serve a clear purpose or align with your current financial goals. And it's at this point that's important to remember that the clutter can lead to cognitive overload and stress, making maintaining a healthy relationship with money challenging in the future. All right, so where exactly do you begin once you're ready to start simplifying and decluttering your financial house? Well, you can start by reflecting on your near and long-term financial goals and the values that you have, and ask yourself, what do I truly want to achieve over the next 1, 3, 5, and 10 years, and how will I use my money to help me get there? Then review each of your financial accounts, including your bank accounts, your credit cards, and investment accounts, and consider consider whether each account serves a specific purpose that supports your defined financial goals. As you're going through this process, if you find an account that no longer aligns with your objectives or creates unnecessary complexity, consider closing it or consolidating it. Ultimately, the goal is to simplify your financial life and make it easier to manage your money. And by reducing the number of bank accounts you have, you can streamline your finances and make it easier to keep track of your spending, savings, and investments. This in turn can help you achieve greater clarity and control over your financial future. What's more, as you simplify your financial household, you may notice a positive shift in your mental state. That's because this process of aligning your accounts with your money's purpose can bring clarity and focus to your overall financial decision-making process and help reduce anxiety and stress. Indeed, when you have a clear understanding of the life goals that you're working towards and how your money supports your goals, it becomes easier to make intentional choices that promote financial well-being. Indeed, this newfound sense of financial order can free up mental space and energy for other aspects of your life. To be sure, when you're no longer focused and weighed down by financial clutter, you can devote more of your time and your attention to nurturing your personal and professional relationships, pursue your passions, and move yourself one step closer to becoming the master of your financial independence journey. Well, that's it for now. Thank you for taking the time to listen to the FI Mastery podcast. To learn more about our research, visit us at fimastery.com or email your questions to questions@franklinmadisonadvisors.com. Until next time, I'm Peter Donisanu, wishing you and yours abundant health and prosperity.
FI Mastery Podcast is brought to you by Franklin Madison Advisors, Inc. Franklin Madison Advisors is a registered investment advisor firm with its registration and principal place of business in the Commonwealth of Pennsylvania. Registration of an investment advisor does not imply a certain level of skill or training. This commentary and forecast are limited to the dissemination of general information pertaining to Franklin Madison Advisors investment advisory services and general economic and market conditions and are subject to change without notice. The information shared today is not intended to be personal, legal, investment, or tax advice or a solicitation to buy or sell any security or engage in a particular investment strategy. For additional information about Franklin Madison Advisors, including fees and services, please contact Franklin Madison Advisors or refer to the investment advisor public disclosures.